Friday's employment data was from United States was history low. 20.5 million lost jobs in April. Reaction on this data was at least wondering. How did it affect the market and what to expect this week? I will talk with David Jones, Chief Market Strategist from Capital.com. Hello, David.
Hi.
So non-farm payrolls, how did S&P 500 and the US dollar reacted?
Well, we saw strength really in both markets. We saw particularly for the S&P 500 in the last hour, we saw stocks gain again. And this might come as a surprise to some investors because you think, well, with such a record low, unprecedented level of unemployment so quickly, as you say, 20.5 million, minus 20.5 million was the employment reading for April. Why did stock markets react so well? And I think clearly it was no secret that millions of people, tens of millions of people had lost their jobs. So no secret there, no surprise for the markets. And I think the market expectation was around minus 22 million was the expectation. So the number, whilst a terrible number for the employment market in the US, came in at 20.5 million, so slightly better than expected. I have to say, in the overnight market today, Monday morning here in the UK, we are seeing some of those late gains given up. So the S&P is moving back to start the week, pretty much where it was before those payroll numbers came out, but no real surprise for that negative number.
Yes, but looking at the 20.5 million lost jobs versus 22 million lost jobs, well, it's not quite optimistic, don't you think?
No, I mean, I think plenty of people have been surprised. I have been surprised by how strong this bounce back has been, particularly in US stock markets. You know, we're now, what, maybe 12% just below those all-time highs set in February of this year. And it is, I think, somewhat surprising given the fact that even as we're seeing lockdowns lifted, we're not going to see the economy back to where it was in January. But you can't argue with the strength at the moment. So I think it's still going to be an interesting few weeks ahead if stock markets think that actually we've gone a little bit too far up. We'll see.
Friday was non-farm payroll day. Well, we will have a PI reading in United States. And so what is the projection of the markets? What supposed to expect before this CPI reading?
Well, I think that clearly this is the inflation data for the US, and I think it's interesting, inflation, particularly given the backdrop we have at the moment. And I think rather than worrying about inflation and the immediate number, perhaps the bigger risk is deflation, you know, or suppressed inflation, because we've had incredibly low oil prices, of course. Other commodities such as the likes of, you know, copper and silver, for example, have been under pressure as well. Agricultural commodities have been under pressure. I think when we see economies get back to normal, we'll see plenty of discounts you'd expect by retailers and various other companies. And also perhaps further down the line, if we do see economies struggle, there could be some pressure on salaries. You know, I don't think we'll see many people expecting significant pay rises for the rest of the year. So I think whilst this week's inflation number perhaps won't tell us too much, I do think it's a really interesting story to watch over the next few months. And I think perhaps we should be worried about falling inflation and perhaps even deflation, you know, given what economies will look like once we come out, hopefully, of the worst part of the coronavirus pandemic.
Tuesday will be CPI in the United States, but Wednesday we will have a Bank of New Zealand. So tell me, do you think that the further interest rate cuts are possible?
I don't think we're expecting an interest rate cut this week from the Bank of New Zealand. I think, like other recent central bank announcements, like the US and the Bank of England, no change to the rates they'd moved to anyway ahead of their normal announcements. New Zealand does seem to have contained very well, perhaps given their geographical location and the steps they've taken, the spread of the virus. So I don't think we'll see a cut in rates. Their rates are, I think, at 0.25% anyway. But there is always, I think, the potential for more quantitative easing, as we've seen for other economies around the world. So no cut to rates, but the central bank trying to pump more money into the economy. We have seen the New Zealand dollar under some pressure versus the US dollar historically, but it has bounced back quite strongly in recent days, the New Zealand dollar. But I think what to watch for here from the central bank is what do they say about quantitative easing rather than interest rates. So don't be surprised if they announce more sort of QE steps this week.
So you can see in this week, we can see some New Zealand dollar strength.
Yeah, possibly. I think depending on how much they say about quantitative easing, we have seen a bounce back by the New Zealand dollar from fairly low levels over the last few days. So I think barring any surprises, we could see a bit more New Zealand dollar strength. But I have to say, if we look at the US dollar, it's been a very messy trading, I think, in the last few weeks. I think we've seen, we did have some great trends in the US dollar of strength over recent years. But given the state, no one actually knows what economies are going to look like in a few months' time. I think we're seeing something of a scrappy sideways trading. But going into this week, the New Zealand dollar in the short term is strong.
Virus hit all global markets, and looking at the United Kingdom, especially projections for preliminary gross domestic product, what can we say about it?
It's going to be an interesting number this week, as you say, because the quarterly GDP will include April, and April was the first full month of lockdown in the UK because of the coronavirus. So we went into lockdown the last week of March, and April, clearly there was a massive hit to the economy. So the expectation is for the UK economy, I think, to show contraction, so a shrinking of around 7% in the 3 months to the end of April. So I think it's going to be a really interesting number. The Bank of England last week came out with a very pessimistic outlook for the rest of the year, saying the UK economy is going to suffer its sharpest drop in more than 300 years, and forecasting unemployment to double in the UK really in the months ahead. So I think this number this week will be watched. We're expecting -7%, and I think it's really just the start of some very negative readings for economies around the world.
Looking at the pound and looking at FTSE, what are you thinking about these two assets? Well, I'm talking about this in this week. We will see this preliminary GDP from April. As you said, it's the full month of lockdown. And do you think that traders, investors are thinking, okay, we are not supposed to see some good numbers. That is why all it's in the chart, all it's in price? Or do you think that maybe there will be some kind of surprise?
I think, like you say, traders are expecting weak numbers. We did see the pound in March trade to its lowest level since 1985, which is incredible. A 35-year low on the pound. We had against the US dollar. We have seen it bounce back since then, and like some other currencies, it's stuck. Sorry, it's stuck in what is a bit of a sideways range overall. So it might be, if the number ends up being not as bad as expected, we could even see the pound bounce back against other world currencies.
Mm-hmm. Okay, David, thank you very much for this conversation. Thank you for your analysis. My guest and yours was David Jones, Chief Market Strategist, Capital.com. Thank you very much.
Thank you.